The nature of pressure, not panic markets, rarely fail at the moment of shock. They fail during periods of accumulated pressure, when multiple stress points overlap, and the system is forced to reveal its weakest component. At this moment, three forces are converging quietly: strategic competition between the United States and China, regional instability spreading through energy-sensitive regions such as Venezuela, and a global monetary system operating under sustained inflationary stress. Silver sits at the intersection of all three. Geopolitical pressure does not behave like fear. Fear is emotional, visible, and often short-lived. Pressure is structural. It builds without headlines and expresses itself through logistics, availability, and liquidity. The current global environment is not defined by a single crisis. It is defined by overlap. Why silver, not oil, not gold, feels this first. Gold responds to monetary fear. Oil responds to supply disruption. Silver responds to systemic stress. Unlike gold, silver is not primarily hoarded in vaults. It is consumed. It disappears into solar panels, electronics, grid infrastructure, defense systems, and medical technologies. This makes silver uniquely vulnerable during periods of geopolitical competition, because demand rises precisely when supply flexibility disappears. The US-China dynamic. Two systems, one metal. The United States approaches silver primarily as a financial instrument. Price discovery is dominated by futures markets, derivatives, and paper settlement. China approaches silver as an industrial and strategic input. Its concern is not daily price volatility, but long-term availability. These two approaches can coexist only when supply is abundant and global trade remains frictionless. That condition no longer exists. As US-China competition intensifies across technology, energy, and defense, silver moves quietly from commodity status into strategic relevance. Markets do not price that shift immediately. They discover it later. Venezuela and the energy metals link. Venezuela is not relevant because of silver production. It is relevant because of energy flow and political leverage. Energy instability does not only affect oil prices, it reshapes infrastructure demand. Sanctions, regional conflict, and energy transitions increase demand for electrical systems, grid resilience, and alternative energy, all of which are silver-intensive. When energy insecurity rises, silver demand does not spike suddenly. It becomes persistent. This is the most dangerous form of demand for a fragile market. The dollar pressure factor. The dollar does not need to collapse for silver to reprice. It only needs to lose efficiency. Debt expansion, deficit financing, and global trade fragmentation reduce the dollar's effectiveness as a neutral settlement medium. In such environments, capital does not flee dramatically. It reallocates quietly toward assets that function outside political alignment. Silver occupies an uncomfortable space for policymakers, too industrial to control like gold, too monetary to ignore like copper. Paper markets versus physical reality. The silver price most participants see reflects transaction confidence, not availability. Futures markets function smoothly as long as settlement remains financial rather than physical. But geopolitical stress changes behavior. When supply security becomes relevant, delivery matters. Vault movements, inventory drawdowns, and delivery preference shifts rarely make headlines, but they change market behavior long before price reflects it. Why this is a critical window. A critical window is not a prediction of collapse. It is a period during which normal market behavior becomes unreliable. Silver does not explode upward without warning. It disconnects first. Liquidity thins, spreads widen, availability tightens. Price follows last. This window exists when stress continues without resolution, not when panic peaks. Historical pattern, always the same. Throughout history, silver repricing events share a common structure. Geopolitical or monetary stress persists. Industrial demand remains inelastic. Paper markets maintain price control temporarily. Physical availability tightens quietly. Price mechanism breaks suddenly. The trigger is rarely news. It is exhaustion. Why most market participants miss this. Modern markets are trained to react to data releases, headlines, and central bank statements. Structural shifts do not announce themselves in this language. They reveal themselves through delivery delays, procurement changes, and inventory behavior. By the time price responds visibly, positioning opportunities have often passed. The role of China in the endgame. China does not signal accumulation publicly. It adjusts policy. Industrial demand is prioritized. Export exposure is managed. Strategic materials are secured without noise. Markets mistake this silence for inactivity. It is not. The United States and financial confidence. The U.S. financial system depends on trust in paper settlement. This trust remains strong, but not unlimited. Extended geopolitical stress, currency dilution, and supply chain fragmentation slowly test that confidence. Silver is where that test becomes visible first. Final warning, not a prediction. This is not a forecast of a specific price. It is a warning about behavior. When silver stops responding to headlines and starts responding to logistics, the market has already changed. The US-China rivalry will define this decade. Venezuela-style regional stress will complicate energy stability. Inflation will continue to distort measurement. Silver will not headline these developments, but it will absorb their pressure. And when markets fail to recognize pressure early, they are forced to recognize repricing later. End statement. This is not panic. This is positioning. And silver is entering a window where normal assumptions no longer apply.